All right, thank you, everybody. So we are going to get this underway on time as advertised. So we are here for a briefing from Nick Donnelly, who's our General Manager of Finance, and it is on the financial strategy and sort of all things finance, which is quite a broad topic, but it's really, again, just to provide that foundation, that understanding. But an apology from Kevin, an apology from Gretchen, who may join online. She's unwell, so she's headed home, and I do expect a number of our councillors to be back shortly and join us, but we will get underway in the interim and they can catch the start of it as we go. So Nick will take charge of this. I'm really just here to manage questions if we have any. I think we'll sort of do questions as we go. It's more a discussion format to enable you to interrogate where you need to. Obviously, if we can't answer stuff as we go, it'll give us an idea about what further information we need to be sharing. So I will hand over to Nick.
Okay, hopefully my computer's on mute. There's no feedback, so it must be. Right, so as Richard said, we'll call this one financial strategy, just what we've got in it. And I appreciate there's a lot of slides, and I also circulated a few other attachments which, are mentioned in this, but they'll probably be useful for you just to reference back and have a read through, at your leisure and as you go through various parts of the triennium. But what we're going to cover is financial management under the Local Government Act, because there's a whole section on financial management in there, and that's what we follow in doing our finances. A couple of things then that are mentioned in there, and I've got sections on that. One is financial strategy, and we've got a financial strategy. It's in the long-term plan. So I'll take you through the key points of what's in that. Also, under the Local Government Act, we have to have a revenue and financing policy. So I've got a whole lot of info on our current revenue and financing policy and what we did as part of the long-term plan around where we did quite an extensive review of our revenue and financing policy for the last long-term plan. Then I've got a bit of just sort of general information on rates that hopefully just gives you a bit of background and a bit of context to where we are as ORC, and just some other general info. With all of this, like Richard said, there's a lot of info here, and even more info in those 3 attachments that I provided. Don't expect you to sort of, to recall all of it and remember all of it on the basis of what you're going to hear over the next hour or so, and there won't be a test at the end of it, so you don't need to. But hopefully it'll give you some good background.
Me, I didn't order it.
And some and you'll be able to reference back to this info and think about if things come up. You can just come and have a chat, or if you want to go through any of this in any more detail, just give me a yell and we can do it at any point. So into the first section, which is financial management under the Local Government Act. So as I said, there's a whole section on financial management in the Local Government Act, and it outlines 5 key obligations for council. So those are the 5 there with the sections. Again, so if you're that way inclined and you want to go to the legislation website, I think I can see Neil's going, yeah, I'm going to be there, and you can go there and have a look at those sections. But what I've got in the next few slides is each of these 5 key obligations. I've just sort of I've got them here and just outline roughly what they mean and how ORC has followed those obligations as we go through our financial management. So I'll go through each one of those. First one is prudence. So that's section 101. That's the 2 parts of section 101. It's quite a still on that. That's my page. It's quite a key part of, you'll hear prudence talked about quite a lot when, when debates and financial decisions are going ahead. What it says there, if I go to the next one, is effectively, this is a summary of what was in the previous slide. All financial dealings are subject to prudence. It's great that they say that local government Act doesn't actually give you a definition of what prudence means. So it does say that you've got to consider current and future, and then it says some things that, these are the things that we sort of take into account when we're considering prudence. If you go, the other thing that they then do is there's a separate piece of legislation, so the financial reporting and prudence regulations, that outlines some fiscal benchmarks. They cover those 7 things there, although 2 of them are you only report on them when you do the annual report, so you don't have to put them in the long-term plan or annual plan. Key thing to note about benchmarks is that, or the prudence disclosures, is that they are indicators and they're not some sort of cap or a statutory limit. All you have to do is report against them. There's no punishment if you don't meet them. And the limits that you put in there are up to the council to decide. So it's not like that's not true. Some of them are sort of set. There are limits in there, but some of the other ones, like limits on rates or rates increases, are set by council.
Do you have to report to anybody other than your community?
Well, you report.
Reporting, is it reports to government, for example?
No,
just demonstrating the information to the community.
Yeah, we do provide our annual report that effectively gets filed. I can't remember who we send it to. Do we send it to the DIA? So, and obviously we're audited, and then the Auditor General is looking at all of this. But as such, it's not, there's no reporting requirement like that. Yep. I did put there, these are just, so these are sort of 3 pages. The little one on the right was just to fit the 3rd in, but that's what you get when you get the LTP, your prudence disclosures. So you've got those benchmarks. There's 5 benchmarks, but we have 2 for rates, one on the actual dollar volume of rates, and one on the rates increase. Yeah, as you'll see there, the orange means that we haven't, whatever the benchmark in it isn't being met. Green means that it is, but there's no requirement to even that. When we did the LTP, you can see there, the balancing the budget one has orange in there. It's very, very close. It doesn't, there's not a requirement for it all to be green, even when you set the LTP.
Are there questions now?
Yeah, we'll do
I've
questions.
always wanted to ask this question.
Could you take that back, please?
That one?
I assume you've answered it, we're late, so I apologise if you have. How do you determine whether or not rates are affordable?
How do you determine?
No, well, you've got a rates increases affordability index there.
Yep.
A benchmark. So where do you set that to say this is affordable?
So in the LTP, so the black bar, so those first 2, you've got rates, income affordability, and rates increases affordability. So the income is the pure amount of rates, so the dollar amount of rates, and the other one is the percentage increase. The black bar is the limit or the benchmark amount that is set in the LTP.
So it's an arbitrary thing that we choose.
Yeah, absolutely.
Right.
And council, so as you go through, you're saying that's what it should be. And then as we go through, obviously it's quite easy for the first year. In subsequent years, if things change, it might be that the actual rates amount or the increase amount goes above what was set for year 2 or year 3. And we have to report on it in subsequent annual reports and annual plans. But the black bars there, what that is set by council during the LTP process.
So it's really a bit of a misnomer to suggest that it's affordable, isn't it? It's just, it's an arbitrary level that we set at which we'd prefer not to go above. We don't actually test whether or not people can.
It's not community affordability. I think that's the question, isn't it? Yeah, it's not a measure of the community's capacity to afford the rates.
Yeah, not if you like individuals. I mean, you'd be considering that, but what you're basically setting is how much do you think an overall dollar amount of rates will be affordable to the community? And that might be, whatever case, 60, 70 million. That's not to say that within that for certain people, whatever their rates that they may or may not be getting, may or may not be affordable to them individually.
So have we put in 10% a year, every year from 2027-8 to 33-34? Is that what the long-term plans do?
That's what it says the benchmark was, yeah. Yeah, as you can see there, the actual, what we had in the LTP were the green bars, so it was well below that. But it was saying that for the purpose of this disclosure, the benchmark was that in any 1 year, rates increases wouldn't be more than 10% after we got to from year 3 on.
Is that determined in the long-term plan?
Yep.
Bloody hell, what were we drinking? Okay, thanks.
Right. The second one that's of the obligations is a 2-step funding process. So this is how you go about determining who's going to pay, and whether you're going to set, whether you're going to use rates, and if you are using rates, which rate payers that would be. So you have to go through a funding needs analysis for each activity. In this section, you can see there in section 8, there's 5 key considerations listed, and then there's an overall. So just to summarize that, what we do is we undertake funding needs analysis for each activity. So we're not doing it total council level. You actually dive right down into an activity level. You have to fund what the legislation says. You fund the activities from the sources that are deemed appropriate. And the appropriate is sort of quite an important word in all the the funding considerations. Of those 5 considerations, you must consider all 5 of them. And when we do the funding needs analysis, and later when I look at the revenue and financing policy section, I've got an outline of the spreadsheet and the template that we use to determine that. So we do consider all of those things, the who benefits, the period they benefit for, community outcomes, but there's no weightings listed there. So how you weight those considerations is up to you as the elected members. And you've got to, but you do just have to consider all 5 of them. The last point there, those considerations, they cover our funding principles that we've got in the revenue and financing policy. So, distribution of benefits. So who should be paying, and whether the benefit is effectively public or private, or whether we should be looking to fund things through fees and charges. That gets considered. Period of benefit, like whether the intergenerational equity principle. So, is it a long-term or a short-term benefit? And then the other one that is one of those 5 is the exacerbator pays principle. So in step 1 of the 2-step process, and we did this in the LTP, we went through and reviewed all the funding needs analysis. What we did that was different in the last LTP and in that review is we did try to include more of a focus on outcomes and well-beings. We probably previously the focus had very much been on the technical benefit side. So by moving to, is there a wider community outcome and well-being, it allowed us to look at general rate allocations. We tried to make those a bit simpler and a bit more consistent. We tried to move away from a a large number of targeted rate benefit zones. And more apply that if you're in a targeted rate benefit area, then everybody's integrated and paying similar rates in the dollar. And we tried to move away from separate rates for small amounts, just because administratively it's just a lot of work for very little benefit. And we also previously had, we used to differentiate general rates per district. So we had some district general rates. We've moved to, when you see general rates now, it's a general rates apply to the whole of the region. And there's no separate district general rates. If something is going to be rated to just a district or to an area within a district, that'll be a targeted rate now. Just so that it's very clear that general means the whole of the region. So benefit assessment was still a key part of the consideration, even though I said, we're focused on outcomes of wellbeings more. Just a little table there. Effectively, if you consider who's likely to benefit, if the whole community, the whole of the region is likely to benefit, it'll probably be a general rate. If there's a defined group who benefits and you can identify them and it's possible to rate them, that'll be a targeted rate. Where it's just individuals individually benefiting, that'll probably be funded via user pays. Examples of that are bus fares and consents, fees and charges. And then if you look at the time frame for when benefit might accrue, if it's immediate, sort of short term, it'll probably be it leads more towards rates like general rates. If there's ongoing and long-term benefits, it leads more towards targeted rates. But some activities we've got in there as we went through the funding needs analysis, they can be funded by all three sources. Can be an element of user pays, some general rates and some targeted rates. Other one that gets considered is exacerbators. We don't sort of rate or use that a lot. It's often hard to determine who they are and to rate for them, and then hard to consider, even if you could, how much they should get rated. But it does happen. I mean, the example we've got is the Alexandra flood scheme, where Contact Energy, which Neil will be aware of, they pay the bulk of that, of the cost of that activity. The rest of it is then is funded through rating. And the legislation says that for exacerbators, they have to, it's through their action or inaction, which again sort of complicates it, because they've got to actually have done something, or deliberately, if you like, not done something. So quite often, exacerbators, people tend to go, oh, it's, proximity makes somebody an exacerbator, but the question is, does it actually? Step 2 of the 2-step funding process is then to look at the overall result of step 1. So once we've sort of determined individually by activities, we then like to look at the overall result in the mix of all the funding needs and what rating that would result in. So we consider the overall level of rates, and we do that. We look at the total dollar amount. We look at averages, average rates. We look at the levels, average levels of increase as well. We also do a lot of analysis around the largest rates amounts and increases. And when we do an annual plan, you get the rates resolution. In the rates resolution, we will state who the usually the 3 biggest rate payers are in the region, and how much their rates are, and what the increases for those properties. 3 biggest are usually the 2 dams and the stadium are the 3 biggest. But we look at that sort of level of detail. We then look at overall, when you're looking at the overall if you like affordability or rates result, we look at the use of differentials, and particularly the use of the uniform average general rate. So for general rates, we charge a portion of it as just as uniform, not based on capital value. So depending on where you set that, how much you set that in the percentage of your overall rates, it will shift the dial on who pays. Because obviously the higher the UAGC, the less high capital value properties will pay. So it can make quite a big difference in trying to deal with, you know, large capital value commercial properties and dealing with the difference in capital values between the districts.
Can you explain to us, please, the UAGC, because our newer councillors won't be aware how it works, but also the principles that drive the setting of?
Yep. I've got, this is sort of, these first ones are the overview of what's in the legislation. I've got more info on the UAGC and stuff later on. So if we cover it there, and then if we haven't covered it, you want to dive into it more,
yeah,
probably tick it off there. Yep.
Well, where do the rates comparison to other regional councils come in?
I've got a slide on that later as well. Yeah.
Oh, yeah, no, the principle,
Oh,
considering the rates of other councils, how do they come in under step one?
oh, well, what we do is usually before we get to the point of setting the rates and when we did the funding needs analysis, we looked at where we were sitting in comparison to other regional councils. And I've got there's a slide later that shows actually not when we did the funding needs analysis, which was for LTP, but I've pulled out what the other regional councils' rates, you know, their average rates are for the current annual plan year. But it's something that usually we periodically we put up in front of council to say, where are we sitting, you know, in comparison to other regionals.
I can see how they're interesting to us, but I'm wanting to know how they fit in with the funding needs determining to be appropriate for community outcomes, distribution of benefits, period, extent of inaction, whatever.
Yep.
It doesn't seem to fit into any of those.
It doesn't, because this is step two. Those five considerations are step one that you're doing individually on an activity. We then look at what the result is that we get from an overall rates point of view, you know, because the funding needs analysis might tell us, for example, as we go through every activity, you might go through and go, oh, every activity should be funded via user pays. And then you come to the end of it and you go, what does that mean? It means, oh, we're going to have an average rate of $10. But, you know, users of buses and different things are going to pay massive amounts. And that's fine if that's where you land. What we would do is we would go, where does that sit? We've largely got similar activities to other regional councils. So if we were sitting there and we went, oh, well, look, all the other regional councils, particularly the ones similar to us, are sort of rating about, you know, $600 on average, and we're sitting there rating $20. You'd go, oh, that's interesting. Why are we fundamentally so different? Or conversely, we might sit there and find we're rating $1,500 and we go, why are we so high? So this is a view over the top after you've done step one. Financial strategy. So yeah, third obligation. There's actually two parts to this. There's section 101A is that we have to have a financial strategy. Section 101B, we also have to have an infrastructure strategy. I haven't covered that off here because it's not financial, but that's what the Tom and the engineering team live and breathe by. So they do the infrastructure strategy. Both the infrastructure strategy and financial strategy are included in the long-term plan, and they're audited. There is actually, you can actually do a joint financial and infrastructure strategy, so have them combined into one. We don't, and most other councils don't either, particularly regional councils. But you have to have a financial strategy, and it has to be in the LTP. So the key aim of the financial strategy is to present the financial vision and consequences of the LTP. So it basically, it explains how the work is going to get paid for. Provides that overall direction and where we're going to end up financially, you know, over the term of the LTP and at the end of the LTP. Also has information there on the issues and consequences of the various points that are in the LTP. And then that last point, the financial strategy isn't about explaining what we're going to do. It's just about explaining how we're going to pay for that. So the rest of the LTP and other things like the infrastructure strategy, they outline what we're going to do. Financial strategy is all about how we're going to pay for it. It does have these points in subsection 3 that outlines what's got to be in the financial strategy. When you actually look at that, but a fair chunk of it is sort of focused on things like roads and footpaths. It's focused on TAs rather than us. It actually doesn't, if you looked at that and said, oh, if that's all we've got to put in there, you wouldn't actually have to say very much. You could cover that quite briefly, but that's the mandatory information that has to be in there. If we want to tell the financial story, you know, and so that people can understand it, we actually put a lot more information into the financial strategy than is just required under that section of the Act. As we go through the financial strategy, you know, ideally you set your financial strategy and then you do your LTP, but there's quite a lot of what goes into the LTP or into the financial strategy can't be completed until after we've done the actual underlying LTP financial estimates. Some of those key assumptions can be set up front, and we do, you know, like how we're going to use debt, investment returns, capital repayment terms. So we did all of that last time. We set what they are going to be up front, but the results that come out of you know, how much are we spending over the 10 years, etc., they can't get done until we finalise those bits of the financial strategy after we've set the estimates, and that's when we do like those prudence graphs and everything. The last financial strategy focused on some key changes to the previous one. We looked at the term of capital expenditure repayment, largely because in the last LTP there was a big increase in the level of capital expenditure. Previously, we'd probably look to fund things or repay over a relatively short period of time. But with the level of increase, we extended the capital repayment term out to 30 years. We had a big focus on balancing the budget and on dealing with historic deficits, which we had particularly in the transport activities. And obviously there was implications to the financial strategy for what came out of the revenue and financing policy review, and there was a few rates changes. So those were the key 3 sort of themes that were in the last financial strategy, but we'll go over that in a bit more detail in that section. The funding and finance policy, so this is the 4th one. The LGA sets out that we must adopt those funding and financial policies. So we've obviously got all of those. Some of them don't apply to us, like local boards, but we've got all of the others. We actually introduced the development contributions and financial contribution ones in the last LTP. We didn't have one prior, but we were meant to. Liability management and investment policy, we combine that into a treasury management policy. And I think I've got in the notes here, I've got it down there. So we combine those 2 into a treasury management policy, which you're allowed to do under the Act, and it's quite common that councils do that. Of those policies, the revenue and financing policy is the only financial policy that's required to be in the LTP. And because it's in the LTP, then it by default is audited. And it can be amended at any time. But as with all things, it's the same as with any amendment to an LTP. Depending on on the level of significance, it may trigger an LTP amendment. And if you do an LTP amendment, then you have to be re-audited. It also states that the revenue and financing policy is the first step in the rate setting process. So you have your revenue and financing policy, which has been driven by your funding needs analysis. And then once you've got your revenue and financing policy, that sets up your funding impact statements, and in turn that flows into the rates resolution. And they're all a joined process to set your rates. You do have to apply that two-step process. Revenue and financing policy has to be adopted before the LTP. It's included in the LTP, but has to be adopted first. So you'll probably see when we adopt an LTP, there'll be a resolution to adopt a revenue and financing policy. It will always occur before the adoption of the final LTP. It might only be 30 or 40 seconds before, but it's always before. Although I said that it's actually the same for significance and engagement policy is a policy that's included in the LTP as well. And that should be I think that should be adopted before as well, but it's not a financial one, so I haven't got into the detail of that. Yeah, we've got we can combine the liability management and investment management into a treasury management policy, and we've got both the revenue and financing policy and the rates remission have to support the principles of the Te Tua Whenua Maori Act 1993, and we reviewed all of that, made sure that we got that updated, and were complying in the last LTP review. So still on revenue and financing policy, it's quite prescriptive about, outlines the permitted sources of funding. So they're all the things that you'll see as you go through our LTP. There is subsection J here that allows for any other source. So there is a bit of a catch-all that if you can come up with any source of funding, it can be used. But A to I are the core funding sources that councils use. And revenue and financing policy has to outline how we complied with the two-step process. So that's mentioned in there as well. Balancing the budget. So it's a requirement there. Section 100 outlines the requirement to balance the budget, which is to ensure that each year's operating revenues are set in such a way that they'll meet that year's operating expenditure, and gives some then the considerations that should be used. There is a balancing the budget calculation in that benchmark. They're similar, they're slightly different in that one includes vested assets and property revaluations, but they're excluded in the other. Pretty much come out the same for us, so it's not really a big deal. But you've got the balancing the budget section requirement in the LGA. We've also got the benchmarks that we do that show that. Says there the requirement is that the operating revenue is sufficient. It doesn't say that it has to equal exactly. It doesn't say that it has to be greater than. It sort of implies that there'll be having a small surplus is prudent, but that might not be the case. It applies to, when you do this one, unlike the funding needs analysis, it applies to council, the whole of council revenue and expenditure, not individual activities. So some activities may not be balanced. Some might be in deficit, some might be in surplus. So there's a lot to consider. But overall, this is saying that it should balance at an overall level. It applies annually, so you shouldn't really just be thinking of, oh, so long as over the 10 years I balance. The aim is that each year you should be balancing individually. And it also allows, and this is where it's quite key for you as the elected members, that you can have an unbalanced budget. There's nothing wrong with it, and for whatever reason, there may be times when a deficit that you will determine is the right thing to do, and that it is financially prudent. In the same way, you know, in some cases, big surpluses might be prudent. It just states there, you just have to consider that, and anytime the budget doesn't balance, we just have a resolution that acknowledges that. And I think the key point there is that by having that means that you're making a conscious decision to land on the budget and the deficit or surplus that may or may not have resulted. So I've got a bit here just on deficit histories. So because in this council, if you go back, and I've got the next slide, got the actual deficits for each year and then the LTP periods. So we had a period sort of that culminated in 2020 and the 2021 year end, and our auditors raised it because at that point that was the third year in a row we'd had quite big deficits. And Hillary's looking at me because she'll well remember this.
I do.
And had quite big deficits 3 years in a row. We'd had planned deficits and we'd had unplanned deficits. So the issue was that generally the way the planning went is when the LTP was being done, we'd start with year one, lots of new work wanting to be done. We'd go into deficit to get things started, and then we'd increase the rates over the period of the LTP. So deficits would reduce, usually to the point where we broke even and then started generating surpluses from year 4 on. But of course, what would then happen is, as we went into the year 2 annual planning, everybody would re-look at the expenditure, and a new deficit bigger than what had been in the LTP would eventuate. That would happen in year 3. And then, of course, the LTP that was running 10 years, you'd get to year 4 and it would become a new LTP, and we'd start the cycle again with another great big deficit. So what had previously been a forecast surplus in year 4 turned into another deficit. On top of that, there was also other things coming along that weren't budgeted, that were being done, either unbudgeted in a year, and then they were leading to those increased deficits. So the auditors pointed that out, and while they also pointed out, fine that council can do that, but probably want to have a think about, how we manage that, because it's not sustainable in the long term. So over this last LTP, and to be fair, the LTP before in the previous, that triennium that followed, 3 years that followed 2021, but certainly in this last 24-34 LTP, there was a real focus on balancing the budget and looking at what was happening with those historic deficits that had accumulated. And there's the graphs of effectively the last 10 years going back to 2016, but also it's got this LTP period. So up the top, it's individual years. Down the bottom, it's lumped into the LTP periods, which though an LTP runs for 3 years, because it's 10 years, because it's refreshed every 3 years, you can sort of look at those first 3 years of an LTP collectively. So you can see there down the bottom, you can see that LTP 1828, you can see those 3 years cumulatively. We had LTP was the green, so we were budgeting in the LTP for the 3 years to have cumulative deficits of 5 million. By the time we'd done the replanning for year 2 and 3, it was over 10 million. We actually ended up over 15 million, and that was what the auditors highlighted. You can then see in the next LTP, much, you know, we focused on it there, flipped it round a bit. The LTP was actually showing over those 3 years, surplus, slight surplus. The annual plans rephased that, still the same trend, but the quantums had got a lot smaller, to, you know, 2 to 3 million, 2.6 million. Actual came in at more deficit with unplanned, that's the yellow one. And then this LTP period, for the 3 years, we've already got, the first year is already actual, 2025, and then we've got the year 2 and year 3. But you can see the blue, the green and the blue have compacted right down. We've still got a forecast surplus in there. That's because we've still got some property, gain on sale of property still to come on that. But you can certainly see the trend of, you know, it had got away with those deficits really increasing in that period up to 2021. And then, you know, focus has been to turn that the other way. You have a question, Michael?
Yeah, so let's just take the first year, 2016, as an example. You end up budgeting for a loss of 2.3 million, is that right?
Yeah, that was 2.9. If you, 2.3 in the very first year.
Yeah.
Yep, 2.3. Yep.
Yeah.
Yep.
Okay, so there's your deficit. How do you meet that deficit? Through borrowing?
Yeah. So yeah, effectively. So back then, a lot of that would have been in up until the, you know, the year we've just had. We used to effectively have operating deficits in transport in particular. Yeah. So what would happen is, yeah, internal borrowing, the transport reserves would go into deficit with a view that, as we increase the rates sort of at a steadier period, at a steadier state, we will catch that up. But of course, as the expenditure kept going, we were never able to increase the rates quick enough to catch up and get ahead of the expenditure increases.
And so most of these deficits then were accumulated as a consequence of the public transport vote?
No, not all of them. I'd have to go through and just outline what they are. But if you go back to 2019, 2020, you had like 2019, a lot of that would have been around, we had the consents review and the Skelton review, and we increased our resourcing in those areas as a result. So, you know, those papers came back to council and the proposal was, well, if we've got to meet these recommendations, we're going to have to increase. So when those increases happened in that year, they weren't budgeted for. And then of course we had to, you know, you had increases in costs. We didn't necessarily fully rate for that. You know, we were going to step our rates up. 2020, I'm trying to remember which one was it. I think it might have been the 2021 year was that, that would have been COVID. And remember we council made the decision to effectively have zero rates. We still had some of the targeted rates still increased, but I think we had like about a 1% rates increase that year. So a lot got reserve funded that year, just in general operating activity. So flood and drainage as well has always been sort of has largely been deficit funded as well, because we don't necessarily, we smooth the rates. We don't necessarily pay for everything that happens in the year that it happens. And other unbudgeted expenditure that can be in there can be where we haven't rated for flood events, for example, but the operating costs will hit in a year, and then we have to look at what we're doing around the rating to recover that.
So I'm presuming that the years that you ran deficits, you did internal borrowing rather than external borrowing. Is that correct?
Yeah.
So you now have pockets of money or pockets of budget that are currently owed money?
Yep. So in reserve, yeah, when we borrow, and actually now that we've got external borrowing, we didn't bother with external borrowing until a few years ago, because we sort of had enough cash reserves. But now we've got external borrowing, but effectively, when we borrow externally, we don't borrow for each individual activity. We borrow centrally and manage it as a pool. And then that can be lend internally to the reserves that need it. Yeah, so we fund it that way. But from a cash flow point of view, we got to the point a few years ago where we needed to get a core amount of debt just so that we were getting to the point where
You're too much money.
no, we didn't have enough working capital. What would happen is we would run out of working capital cash sort of around about June, July each year until the rates came in. So we could bridge that a little bit, but we needed a core to keep it up there. Otherwise, we would have had to have dissolved part of the managed fund to have the cash to keep lending internally.
So your current debt is what, about $25 million, is it?
Core debt is 25.
So forget that's what it is.
Yep.
But you're mostly carrying that to fund the periods in which rates aren't coming in.
No, we get, right now, our core debt is 25. Right now, our debt is 40, but that, we had a 3-month loan for 15,000 to bridge that rating, the rating working capital. The 25, that's our core debt. And then what that is effectively has been borrowed by those activities like transport and some of the flood and drainage schemes that are in deficit. But that's the core debt part of it. Yeah. So
you're borrowing from LGFA?
Yep. So all of our borrowing is through them, the core debt and the short term, which that short term 15 million was for 3 months.
Thank you.
So just, is there an expectation that 25 million of core debt will be paid down in time?
In theory, but what's happening at the same time, if you look at, and I think hopefully I've got a graph in there that's out of the financial strategy that shows where our debt's going, is yes, if we didn't do any more capital expenditure, yes, it would be paid down. But over the 10 years, we're planning on doing a whole lot more capital expenditure. So in fact, our core debt will go up to fund that. Yep.
So using debt to fund capital projects.
Yep.
That will be paid back through rates over the lifespan of the asset.
Which we now, and we have set that repayment term at 30 years for those capital projects.
We keep on adding to it, so it'll never go away.
Yep.
Yeah.
Yeah, unless we just stop doing new capital, then we could go, okay, now we'll just look at repaying that. There is some of that core debt, in theory will go away as the historic transport deficits are repaid. But it's being replaced by other capital expenditure.
So in simple terms, the core debt is offset by the repayment plan.
Yep. So summary of this section. So financial strategy is how the work's paid for, and that determines the use of debt, reserves, capital repayment, depreciation, and looks at balancing the budget. Revenue and financing policy looks at who pays, and that's based on the funding needs analysis by activity. And then you have the activity plans and the infrastructure strategy, also in the LTP. They determine what we do and what has to get paid for. And obviously, all three of those points, they combine and they impact on the level of rates we need, and ultimately the level of rates, that has to be assessed, therefore the affordability of that.
I think the growth or not in the core debt will be driven partly by the infrastructure strategy and the commitments to the assets that we've got, the flood banks or whatever flood schemes. Yes. No?
Yep. I think if you, I can't remember off the top of my head as we go through it. Hopefully it'll be there. But yeah, I think in the LTP, I think by year 10, we were up to about 100 million of our own debt. And that reflected, the capital program that was being over the 10 years, and that how big that was, and then that would be repaid over the subsequent 20 to 30 years. So financial strategy, So what I got here is a sort of a summary of our current financial strategy that's in the LTP. So if you've, I'm sure you've all looked at or got a copy of the LTP. So it's got, I've got sort of, the key parts that it covers and what's in there. So if you've got questions, you can ask it here or we come back later on. But as I've said, financial strategy, can review it at any time, but it's always reviewed as part of the LTP. So the last LTP, as I said, key things we looked at: debt repayment periods, that's for flood and drainage, increase them to fund the capex over 30 years. And then the other key thing that we looked at in the financial strategy was balancing the budget. And that was really around transport, where transport actually doesn't have a lot of capital expenditure. But we hadn't been fully funding the OPEX every year, largely because as new transport comes online, like if you go back to 2017, I think it was when we brought Queenstown in, you go from zero cost to, I think at that point, maybe about $5 million in cost in 1 year. So it's a huge leap to go, okay, we're going to fully fund that. All of a sudden, people's rates would literally double overnight, from 1 year to the next. So when those sort of things were happening, there was a view that we would step the rates up to get there, which means deficit funding and then repaying. But then as there's been more demand for increased services, costs have been escalating. So we've never really been able to catch the rates up. And then, a few other things came along in transport, like COVID had massive impact as well on our ability to get fare revenue. Costs still were there. Costs, if anything, escalated. We've had other things like increasing costs in transport for driver wages. So, so there was a whole lot which had resulted in us having quite large transport deficits, particularly in Dunedin, where it was over $10 million. And so that the LTP, the financial strategy, moved to saying that we were going to fully fund each year's operating expense for transport in that year. We changed, the financials to reflect that. We also looked we did the revenue and financing policy change up until the last LTP. There had been no general rate allocation for the transport activity. So in that review, we did move to having a 20% general rate allocation, which is in line with what we were doing for flood, and drainage was 10%. But so the 20% was in line with flood. And those deficit balances that we've been carrying, the historic deficit balances, those were ring fenced and proposed to be repaid over the first 5 years of the LTP, and that's what we've done. And where they were ring fenced in that they're still being rated only by the existing targeted rate areas. So they didn't move to having a general rate allocation. So we put a line in the sand, said there's the balances, same rating basis, and we'll pay them off over a period. And the going forward targeted rate, the rates will be split 80-20 targeted general. Just made a wee note there, the 5 years, the forecast amount we had, the Dunedin deficit actually came in higher than what we had forecast. So in Dunedin, it will take longer than 5 years to get that repaid. It'll be more like 6. But it will be paid over predominantly the first half of the LTP. So the financial strategy sections, just to give you a brief sort of run through of what's in here. We have an introduction section. It outlines the purpose, which is the path for prudent, sustainable funding of the LTP. Executive summary outlines those things that were the key things that were in the financial strategy, which I've just mentioned, like balancing the budget, the CapEx funding over 30 years. gives a bit of background on the process that we followed to set the work program. It doesn't outline what the work program was, because that's covered elsewhere in the LTP. Has some basic principles around prudence, fairness, value for money, and transparency. We look at did highlight or discuss the key issues that we saw in the financial strategy, which was climate change, policy direction, environmental degradation, land use intensification, and economic conditions. Probably all pretty standard that you'd expect those sort of things to be discussed. And then the key assumptions that we have underpinning all the financials around population growth, economy, employment, technology, role of council, natural hazards, and climate change. Operating expenditure. So as I mentioned, it outlines that strategy is to fully fund each year's operating expenditure from that year's operating revenue, so to balance the budget. States that reserves won't be used to fund day to day, as it notes that because that's not viewed as prudent. But it does say that in special cases, and gives the examples of one-offs or where activities continue over a number of years, our reserves might be used. And that's where you might get a deficit if we go, well, there's a huge expenditure in 1 year, but in fact, that piece of work is going to be used over 5 years. It's a bit like, it is operating expenditure, but it's a bit like treating it like capital and effectively writing it off or depreciating it over a longer period. But if that happens, then those deficits and what they're for are pointed out in that in the resolution that where council says that it's prudent to do so. So the next page has the operating surpluses and balancing the budget. It's in the LTP. So first graph up the top is the expenditure. So the first one on the left was the annual plan for 23-24, and you've got 10 years of the LTP. So that's our expenditure increasing from about 100, I think it was about 135 million to about 180 million in year 10, and then balancing the budget. So you can see we were forecast or estimating in year 1 a reasonably small deficit, then a surplus in year 2, 4 years of deficits again, and then into surpluses. So, and these are just snips from the actual LTP document. So if you go to the document, you can read there's a whole lot more blurb around these and any key points that might be in.
Sorry.
The transport operating expenditure increase, is that, central government seems to have said that we can't increase our rates to pay for more buses or whatever.
So the transport increase, because they haven't said you can't increase your rates. They've just said they expect to see more private share, which is effectively the fare box recovery. So you will continue to, if we maintain the same services, you will continue to see higher expenditure until, because this is just the expenditure, Nick.
Yeah, that's just
This
the
is not
gross
the-
expenditure.
So that may be funded by higher fare box recovery, NZTA contribution, and then ORC rates contribution. The total expenditure will continue to go up year on year if we retain the same services, because we just have contract increases year on year. So the government in the sort of recent within the last 12 months has provided a stronger direction on councils ensuring that there's more of a focus on collecting private share as part of the funding of public transport services. So we fare reasonably well when compared to other councils. I think we sit just under the 20% mark, and other similar councils are sort of down in the early teens, if that. But it is still something the government expects us to put more focus on and increase that overall private share. Michael?
Busy Ellen.
I'm interested in the graph in the sense of that there are yearly increases. I'm assuming that this is inflation adjusted or?
Yeah.
Yeah.
Yeah, all the numbers in the LTP are inflation adjusted. So year one, zero inflation.
Yeah.
Yeah. But from there, all the numbers are inflated. Yeah, so they do increase as you go out, because to a large extent, for some things, we might go, oh, the cost of that activity is $1 million. We will plug in $1 million every year for 10 years, but you get cumulative inflation. You know, by the time you get to year 10, that million is now showing at 1.8 million. You know, so there is an element of inflation increases those future years quite significantly.
So I'm watching a graph that's really marking inflation rather than a growth in the operations of the ORC.
There's still both in there, but certainly inflation is having an impact.
Could you then, the question that's sort of related to that is then, could you tell me on the basis of that, or on the basis of our long-term plan, what rate of inflation you've calculated, number one, because I assume it's uniform across that period of time?
No.
Oh, really? You've adjusted up and down?
Yeah, it was higher at the start of the LTP, because if you remember when we went into the LTP, inflation was higher. So it was higher. I think by about now, by year 2, it might have dropped to about maybe 2. No, it was under, it was 2.5, maybe 2.2. I think from year 3, certainly from year 4, it was basically pretty much flatlined at about 2%.
Okay. Our primary, apart from bus expenses, our primary expense is staff. So in that particular period of operating expenditure there, have you planned, is the growth of all the staff numbers static or does it increase?
Yeah, so in the LTP, we had increases in years 1, 2, and 3, but we've kept them. After that, it was holding steady. That's my recollection.
Yeah.
Okay, all right, thank you.
That'll be mine as well. So expenditure in the financial strategy document of it, in the expenditure section, it then talks about has some info on capital expenditure. Our capital expenditure is mainly flood and drainage related. Year 1 of the LTP included Whare Runaka, our share of the leasehold improvements was in there, although it had been spread over the previous year's annual plan and year 1 of the LTP. Infrastructure assets belong to the schemes and they're funded through targeted rates, but over the long term. So each scheme has a reserve, and the upfront cost comes out of the reserve. Rates will be paying that back in line with depreciation, and be paying that back over the long term. The last couple of points there, scheme reserves are used to fund the CapEx. If they don't have enough funds, which they don't for large scale capital expenditure, they basically borrow internally and go into deficit and repay it over the life of those assets. Infrastructure asset investment. Now this is a table that's it's on the next page. It's in the financial strategy, but it's basically from the infrastructure strategy. It just outlines the planned level of flood and drainage CapEx, and what you see when you have a look at it, it's that table down the bottom. You can see there, there was a big increase in the level of capital expenditure over the life of the LTP.
Just flagging some of that too is subject to decisions still to be made. So part of that infrastructure strategy is flagging where the team believe there is capital investment required, but there is still work to do in terms of scheme reviews, and looking and bringing some of those decisions to the table. The other thing that's not in there is the central government co-funding of resilience projects, which is what we emailed about a couple of weeks ago now. So those are things that get updated through the annual plan process that Tom and Nick and the managers will be working through. So it doesn't reflect what is now an increased proportion of central government funding into resilience projects. But also the numbers, particularly as the years get further out, are based on forecasts from the team about where that CapEx spend will be required, but will still be subject to decisions made around this table as things get further down the process.
Revenue, so the revenue section in the financial strategy highlights that we use a mix of funding sources to pay for our activities. So this graphs there, you can see the different colours in each bar, just breaking down how we fund it. You will have seen other summaries like this, and I think the planning and performance team had some. I can't remember whether they showed it last week. They'll show it in a in a pie chart or a donut. But these are just bars. You can see in each one of those years, the blue and the red. So the bottom two is our rates. So general rates and then targeted rates. So you can see even consistently as we go through towards the end, we're currently a bit under half of our funding is provided by rates, goes to probably just a little bit over half as we work further down towards the 10 years. But there's a whole raft of different funding sources. Subsidies and grants, a big funding source in transport, also for things like Wilding Pines, where although we fund a little bit to the groups that we rate for, there's quite a big spend and activity there. Can be in excess of $1 million a year. That's just a direct pass through. That funding comes from central government. Purple, then next one up is fees and charges. That fees and charges includes bus fare revenue. So that's included in there. A little bit other income, the investment income, which also the investment income is what we earn on the managed fund, but the big chunk of that is port dividend is in there. And investment income, like our revenue on the managed fund and the port dividend, is used to offset general rate funded activity. So that yellow, that orange bar, if that wasn't there, the blue bar down the bottom would increase by that amount. I've actually got the blue. The orange must just be the port, because I've got the interest income separate in the bar above. Although interest income it'll be the gross amount. It will include the interest that we on charge to the port. So that's why that bar is probably bigger. There's a net off of the of what we receive there. We're just paying straight onto the LGFA for the port on lending interest. And then you've got the pink on the top is reserves. So as you can see, quite a mix. Key thing to note is that, only half or less than half of our funding is via rates. So we've got quite a good, other sources of income. Just a graph there, just on just rates. So the split between general and targeted. So got more targeted rates. Currently sort of fairly 50-50. It does get bigger in targeted rates as we go further on. Again, that's reflective of the capital expenditure going in flood and drainage schemes, and those schemes, the cost of being incurred in those schemes is getting bigger. Rates increases, the bottom graph. The black bar is that benchmark, which after year 3 is set at 10%, and then you can see what our rates increases are. We've actually done 2. We've done it total rates, and then we've done excluding public transport, because particularly early on in the LTP, big driver of our overall rates increase was public transport. Obviously, it's not impacting everybody, because although most of Dunedin pay the targeted rate for public transport in Dunedin, in Queenstown, only half of QLDC as a district pay the targeted transport rate. And the rates increases that we had for the LTP, we had year 1 16.3%, which was obviously what it was. Year 2 in LTP was 13.8%, and then dropping to 8.7% in year 3 of the LTP. We've now into year 2's annual plan, so we redo all of the estimates and the rates. We ended up with a rates increase of 5.5% for the annual plan that we've just set in the current year that we're in, and then obviously we'll be going into doing year 3 annual plan and be looking at what that year 3 number is going to come out at.
Let's try this. So that 8.7 is historic. That was put in the long-term plan.
That's what it was at that point. Once year 2 got changed in the annual plan, it sort of throws that number out the window, because your baseline has changed.
Absolutely. So when you went to 5.5, there's the reason it dropped so much is a combination of 2 things, as I remember. It was that public transport cost as a result of central government changes.
Yep.
The second thing was because the long-term environment fund of $2 million, instead of being rate-based, was taken from the reserves.
Yeah, those were the 2 biggest things. There was a few other things, but certainly those were the 2 biggest changes from what we had.
But the aim was for that to only be for 12 months. So the $2 million will go back into year 3 if all things were given or equal, right? Yeah, because it's meant to be funded at $2 million a year.
Mm-hmm.
And so it'll come out of rates, but that's not recognised in the 8.7 number. It'll be 8.7 plus.
Yeah. Right. Although the 8.7 is there, and it's when we go out to the public, we've got to say, well, year 3 of the LTP is sort of our baseline. We then go, where have we landed? But yeah, once you've changed year 2, once you've changed the base that you're calculating the increase on, you're naturally going to get another number. And when you said, I was going to fund something and it was going to be an increase in year 2, and then you move the increase to year 3, it's going to change that. But there's a lot that we've got to look at when we go through year 3 and see where we land.
It'd be useful for the new councils in particular. So what would, if you added the $2 million back in to the 8.7 and you've defrayed things over, what does that look like? Does that look like 10.7?
Yeah, we did a calculation, because you asked the same question when we adopted the annual plan.
Correct.
So we've done the deliberations, and when we came to the adoption, we did a rough back of the envelope calculation, and if you, all things being equal with what we had in year 3 of the LTP, I think we said it was going to be about 12. So between 12 and 13%.
Yeah, might have just tipped into the 13s, low 13s. So that was the upshot. Yeah, that was, Michael, you're right, the consequence of some of the decisions made in year 2. They obviously have an impact on year 3. So we're preparing that information at the moment to have that conversation about year 3 and exactly where we are at in terms of some direction that we will need from the table. So there's a paper coming to the November council meeting with more sort of the process and the timeframes, and then there's a full day workshop in December to really get into the numbers that we're currently dealing with, and for the council to give us some direction to go away and sharpen things up. So today is more around, again, baseline information, induction material, and then subsequently some of that information that is needed for you to give us some direction.
So all things being equal, if we make no changes at all in November, the estimated rate increase for next year would be 13%, roughly.
Yeah, if you instruct us to make no changes, there are things we are changing at a staff level, but if you were to instruct no changes, just roll it over, that's where we would be at.
Thank you.
Yeah, Neil?
I think I know the answer, but I want to make sure. So year 3 did not have $2 million for the environmental fund in it originally.
It had 2 million, both year 2 and year 3 had $2 million. But it was assumed that both years were rate funded. Year 1 had $500,000 that was reserve funded. So the increase in rates was in year 2, not in year 3.
No, thank you. That's clarified my concern.
And then so around rates, this isn't in the financial strategy, but just put this one here. So, and this is sort of a little bit of the information that that went out. Must have been last week, wasn't it? Yeah. Just on average rates. Yep. So, and by district. So just these graphs, if you look there over the whole district, that top left, there's about 128,000 rating units. And I'll say that's rateable rate units. There's actually more than that. There's like about 134,000, but there's a core of 67,000 that are non-rateable properties. But that's the 127,000 rateable properties, and that's where they are across the districts. You've then got the total rates paid, which is on the top right-hand corner. So you've got, by each district, you've got total rates, general rates, and targeted rates. So you can see there at a total and targeted rate level, you know, Dunedin is paying the highest dollar value, followed by Queenstown. When you get down into general rates, that middle one flips around, and QLDC is, or QL, the Queenstown Lakes District, is paying the higher dollar value of the general rates. You then get into the bottom left is average rates by district. So you can see in total rates, the average rate is 617. And then you can follow that back to the left, and you can see that's almost bang on what the average rate in Dunedin City is. But obviously it's less than what the average rate is in Queenstown, Queenstown Lakes. But it's more than what it is in the other 3 districts. And then got the general rate on the average general rate on the side as well, on the right-hand side. And then just for comparison, because you go, well, why is that the case? And why that is the case is because of this graph on the bottom right. And you can see there, that's the average capital value for each district. And it's not it includes all properties. So it includes commercial property, includes, you know, rural, includes everything. But, you know, you're over 2.2 million as an average capital value for Queenstown Lakes District, down as low as 741,000 for properties in Waitaki. So there's quite a variation in the capital values, and that drives that variation in average rates by district. As I said, one of the key, you know, things that, and we'll sort of touch on it later, is there is the use of uniform rates and UAGC. But over the time that I've been here, you know, what you're seeing with that trend has increased.
Yeah, absolutely.
Yeah.
And that's, so you're going to come to the UAGC because initially that looks really unfair, that you're basically being penalised for living in a larger home and paying greater rates as a consequence, and perhaps receiving even lesser services from us. But you're now going to talk about the UAGC and how you can smooth that out, eh?
Oh, I'm not in any detail. I've just got
Yeah.
explain what the UAGC is and how it's calculated a bit later on.
But that's current.
Yeah, this is the current 2025-26 year, what we struck rates on. Yep. And it's GST inclusive.
I just wonder, and it doesn't necessarily need an answer today, but just something that you said about the 3 biggest ratepayers So you've got $250,000 in rates coming out of the stadium, another $250,000 coming up country from some dams. Do they skew those figures in terms of if you took that out, would that make any difference to those percentages? And the second part of that question, if you took their capital values out, which are all quite large as well, does that do anything to dare I say, to skew the numbers that sort of make a more normalised one?
But I don't know, it's a simple
Yeah,
answer. I'd
right.
have to go and take them out and just see if it did. And I probably think not. I mean, you know, they are big capital values, but I mean, the capital value base of,
Yeah,
you know, of the over the whole region is massive.
127,000 times 1.2 million is the capital value of the whole region, right?
Thank you for saying that.
Don't know how many zeros it
Takes
is, but
it
there's
away.
quite a few.
Can I ask another question to do with this graph? And that is it possible? I mean, first of all, what's it based on? I assume it's based on QV, yeah?
Yeah, okay, yep.
So when was the last time a QV was done?
Well, it varies. I've got a little bit in there. It varies for each district. Valuations are redone every 3 years. I'm sure
Yeah.
all of those and everyone here in Dunedin will be.
I'm looking forward to your next one.
Got one yesterday.
There we go. They've just hit the letterboxes. So Dunedin's just been done. Queenstown was done last year. So they operate on a cycle every 3 years. The thing, again, I talk a bit more about this, but things like general rates done on capital value. We do have some rates done on land value and on land area, but certainly the bulk of our rates are charged on capital value, except for the things that we've got. So we've either got the UAGC, which is uniform, which is just per property, everybody pays the same dollar amount, and there is some other rates that are done on that basis as well.
So the other thing at the moment is that we know also the real estate figures came out this week, and they showed that there's a sort of a circle around Queenstown, as you know, and Wanaka, and that halo effect has come down the gorge to Cromwell, and to a lesser extent to Alexandra. But the average values for properties in Dunedin have either stayed static or just come back a bit. So that will be reflected again in the rates that you will do for the 25-26 year, your general rates.
Well,
No, 26-27.
yeah, but because we've struck these ones, what we do though is every year, because capital values are at that point in time, and at any particular point in time, like Dunedin's, for example. Yeah. The valuation that we were using was 3 years old for the rates we've just struck. But we do what is called equalisation, where QV provide us a certificate, which is just a percentage to apply to each district that hasn't got a current valuation.
Oh, they make an estimate.
Yeah, and so for example, there were, and I can't remember what the percentage was. So we were already applying to the 2022 a percentage that altered that, and that's why when we show things like rates, general rates in our rates resolution, we do it per district, and the rate in the dollar will be different to take account of equalisation. Yeah, because you can't actually change the capital value. You have to change the rate in the dollar to use against the capital value. So that's why we have that. In the case of Queenstown, when they were revalued last year and they went up, I think for the 3 year, the average was about 21%. Yeah. But through each of the subsequent 2 years, we had applied equalisation that had sort of taken it up, 10% the first year, and then say, 7%, and then the final year. So they didn't get hit even with, if you like, a 21% hike. It had been cumulatively put in those interim years. Yeah. Although the full valuation is far more accurate because it does it across suburbs and everything. And land use type. When we get equalisation, it's just a percentage that applies across uniform, across the whole lot on the same basis.
So just noting where we've got sort of 30 minutes in the scheduled session, we can probably go through to 1:45. We're only walking across the road for those that are joining us, but I think we're now halfway in terms of slides. So just very happy with questions because it's good baseline information, but also if there is stuff we know is coming in subsequent sessions, we'll just keep moving.
hard for me to remember what's in the other one.
You're
because
just
there's so
surprised
many.
with so many questions
Some-
on financial.
Some of the ones at the end we don't need to go on. Oh, so this next one is the other regional council rates. Yep, so again, I did update this to reflect what's in the current annual plans for each council. So there's us at the top. We're sort of, this is GST exclusive, so it's different than what you just saw. And we're sort of at about, bit over 500. So if you look here, you drag that, if you go down, we're second lowest, have been sort of fairly consistently. There was a period where we were lowest, but we're second lowest. Taranaki's lower than us. Shows the split that most councils use a mix of general and targeted. Wellington, way bigger because they've got one, a much bigger transport network, and two, they do water.
And regional parks.
I think it's water that's their real big driver of their cost. But we're certainly there. That you can see there's a whole bulk of councils sitting there. Yep.
Have we got any information from other regional councils about what they're spending their rates on? I mean, we may be near the bottom for charging rates, but we may be providing nothing. I mean, so do we have any
It would.
comparisons there?
I don't. Previously, I've sort of looked at that. It takes a lot of time to go through. It's very hard to go through. You don't know, even when they say it's this activity, you don't know exactly what they're doing in that activity and whether it lines up with what we do in a similar activity. But we have looked at it, and we could go and pull the data and do a bit of a benchmarking exercise.
Yes, no, I see it would be a lot of trouble and things. I'm just saying without the value for money query, how much they're actually charging sort of to some extent not terribly relevant, is it?
Yeah.
Well, another measure is what a house that's $1 million in Wellington and $1 million here, what do they pay? Is another way to do
That would be good,
look at
yeah.
the comparative balance, because an average rate is a bit weird, and if the average CV is different. So
Borrowing. So we introduced external borrowing through the LGFA back in 2022. We've got borrowing limits that are set in the Treasury management policy. So our net debt has to be under 175% of total revenue. We've got net interest expense has to be below total rates and total revenue. We've got to maintain liquidity. They align with the covenants in the LGF. They're in our Treasury management policy and the LGFA covenants. We provide on lending to port through the LGFA, because LGFA lending is roughly about 1% cheaper than just market rates. So they can borrow up to 150 million through us. Their lending gets netted out from a net interest and net expense point of view, and net debt. We still have to account for them in the liquidity, where effectively what that liquidity means is if we've got $100 million of debt, we need to maintain 10% of that, so $10 million of liquidity, which means we've got to have cash or liquid assets equivalent to, which we meet that through the managed fund, because the managed fund is a financial asset that we could cash up at any point. We don't know. There's the debt that we had. So borrowing is the security is charge over rates through the LGFA. We don't offer any other security. Internal borrowing, so we do that. This is only external debt. There is internal borrowing. There's a limit on that of 50% of reserves, and we calculate the interest we charge it, or we set it up front in the LTP and annual plans. The debt there you can see has got the limit, and there you've that's done as that goes out that's out on the other. Those bars are on the other graph, but you can see our debt rising over the 10 years, which is what we talked about earlier. Investments. So this is about managed fund and the Treasury management policy. Objective, earn a return while protecting the initial asset. Our risk profile is conservative. That's what we're looking to do. Basically maximize our return, limit our risk. Port Otago, so we own 100% of Port Otago. Dividends are used to reduce general rates. That way, all ratepayers are benefiting from that.
Do you explain intergenerational equity? That term means?
We're about intergenerational equity.
Just on the
The
bottom of
slide
that
there.
slide.
This one here.
Yeah.
Oh, yeah, maintain intergenerational equity between current and future. So intergenerational is just that, current versus future. So we've always taken a view with our investments that we want them to endure in the long term, which is code for, we don't just want to cash everything in today, sell the family jewels, and so that current ratepayers pay nothing for the next 10 years, and then the next generation are gonna pay triple rates. Yep, that's all it is.
Like, yeah, equity from a.
Can I ask where we make that policy? Because
That with this one here.
no,
So-
the one about intergenerational equity in terms of the.
So where it says that,
Yeah.
that one there is, that one, I think is, the last three they're not on the financial strategy, they're in the treasury management policy.
So how do you change that?
Well, we do reviews, so we've done, in the time I've been here, done quite a few reviews of the treasury management policy. That particular clause has never come up for debate, but at any point that we review the TMP, technically, we can review it.
And Nick, in saying the example you gave that you wouldn't sell down the family jewels and then use that to raise rates. Equally, what you could do is sell down the family jewels and reinvest that into a different investment model if that was proven or could show a better return and a better outcome in the long term.
Yeah, because in that case, you're still maintaining intergenerational equity, so, yeah.
Just the nature of the equity.
Or you could spend it on a particular project which was going to deliver intergenerational benefits as well. I know you're gonna hate that,
Sounds
Nick,
like
but-
discussion for a
Yeah,
future
that's
session.
right.
Keep going, Nick.
Put it all on red, Michael. Yeah.
No.
19 reasons.
So
It's the reason.
So Port Otago own 100%, dividends reduce general rates. Policy for Port is that the dividend will be between 50 to 70% of normalised operating profit. So there's a calculation to do that because a big chunk of Port's profit will be unrealised property revaluations, so they're excluded from that because it's not cash. Aims to balance the return that we get with reinvestment in the business. Dividends are increasing over the LTP. So they were 15 million AP leading in, 18 million in year one, going to be 20 million this year, and then it's flatlined at 20 million for the remainder of the LTP. We note in the financial strategy the risk of reliance that, if they don't pay the dividend, we've got a big hole in our funding. Special dividends may be received. They could pay them just if they wanted to, or we could request them, and they may or may not pay them. Dividends are updated in the statement of corporate intent, which they provide every year. It's basically a 3-year rolling document, and we align that with our LTPs and annual plans. Returns on the port there. So valuation at end of June that we've just gone past in our annual financial statements. 788 million. Cumulative dividends over the life of us owning the port have been 253 million. Last 10 years dividends have been 112 million. Cumulative return has been over the life has been 11.5%, and in fact a little bit higher over the last 10 years. That graph there just shows the last 15 odd years dividend returns. So the bars are the dividends, the dark ones are the ordinary dividend. The ones that are sort of lighter grey with the with the stripes around them are the special dividends. So we did receive significant special dividends back in 2011 to 13. That was around the time of the stadium. The red and blue bar are the 50 and 70% of of normalised profit. So you can see, they're certainly over the last few years, they've been in that range. Last year, they were slightly above it, slightly above 70%. Back in 2021, 22, when COVID was around, they didn't have the cruise ship revenue. You can see they still maintained their dividends, even though it took them outside the 70%, which is great for us because it gives us certainty of funding.
So just on Port, there is a session there's a session planned with Port with their exec and board for World Council in February. And ahead of that, looking to arrange an induction session for the new councillors, just to go and understand how the port operates and get some information from them. So that will, we're just trying to schedule that around other meetings when people are in town. But in terms of the whole council and time with Kevin and Tim and others, Tim being the chair, that's scheduled for February currently.
It's Kevin Wonders.
Investment property, council directly doesn't actively invest, but we do own some historic investment property. This one's changed a bit from 3 years ago because all we've got now is a couple of ground leases at the university and Polytech, so Union Street and Harbour Terrace. So we own the land. Obviously, university is developed on top. We value them every year. They're currently worth between the two of them 17 million. And we get, over 700,000 annually in ground lease rent. That just same as other investment income, just is used to offset general rates. We did own a couple of others in the Custom House and Monarch, but we sold them back to Port. They weren't worth very much and didn't give us any real return. Other property. We do own other property. They're not investment property, so they're not in the financial strategy. Kiriwao, you'll hear us talk about that, down in Clutha. There was Kiriwao proper endowment land. Over time, all of those properties have been freeholded, except there's still one remaining. Any rent or sale proceeds go to the Kiriwao Reserve, which currently has probably, I think it's certainly maybe $7 million in it. Has to be used for activities down in that lower Clutha area, and we do use some every year to fund some of the flood and drainage costs. We've got operational leases on flood scheme land, so they're what we call grazing leases for the flood banks that we own. We will lease that land out. Any rental income goes back to the scheme to reduce the cost there. And we've got some other operational property like depots. We own depots. The big ones are Tyree, Balclutha, Cromwell and Wanaka.
About to have Stafford Street and anything else?
Well, Stafford Street is currently, I didn't put it on here, but it's just operational. I should have probably put, head office and depots. So Stafford Street, but once we move, Stafford Street will be surplus to requirements and we'll sell it.
Estimate?
Oh, I don't know. We've got it in the LTP estimate just at capital value, which was about $5 million. Whether I don't know what the new capital value is on it, so that'll be interesting, but we don't know what the market value of it is.
So when are we meant to be moving into there?
First quarter next calendar year.
Does that mean it's vacant and ready for sale it'll be in the
So
next financial year?
We've currently included it in this financial year, and just working with that to get it on the market so that we can see what sort of interest there might be in it, but it would effectively be available before the end of this financial year.
And we've had a valuation done? No? No. Okay.
Waiting for the rate statement to come.
Managed fund. So we've got a long-term managed fund. It's managed by JB Ware. So it's a mix of equities, bonds, and cash. As at end of the financial year, it was worth just under $30 million. We've got a statement of investment policy and objectives, which we call SIPO, that dictates how we run the managed fund, and flows through to how JB Ware will structure our investments. That was reviewed in 2023. We brought in a responsible investment policy, brought in the environmental social governance criteria around that. It was also reviewed again in just this year. At the end of 2024, we just did an independent review of the performance. They made some suggestions, and there was some amendments to the strategic asset allocations, which is the split of what we have in the different asset classes. And we removed separate property allocation. So I've just cut and pasted there. We've got our risk tolerance as a council. We've said we're risk adverse. We've probably got quite a high capacity to accept risk, but willingness is probably quite low from the general public for us to have large fluctuations and losses. So overall, we're risk adverse, and that's reflected in the return that we expect to get, which is 2.3 to 3.1% above inflation. And as a result, because of that, what we do is that's then led us to have a strategic asset allocation that is basically 50%, defensive and 50% growth. Interest versus equities. And these splits of the equities, they were changed over in that last review that we did that just got put in place right in June this year. Returns over the last 10 years, so got them there. You can see a bit like the port, it's made up of income, in this case, interest and dividends and capital gain, whereas the port just has the dividends and capital gain. In this case, the return here over the last 10 years, we've averaged 5.9%, 5.91 in total return. This is a little bit different in that the percentage for income is slightly higher than the port, but the percentage of capital gain that we get out of this is significantly lower than what we get through the port. Reserves, there's two types of reserves. I haven't got into a lot of detail about what the balances are. We'll cover that off at some other time as we work through different things. But effectively, there's two types: public equity and then restricted or council created. So the restricted or council created ones are, we've got a couple of revaluation reserves for the port and our investment property. They're non-cash because they're just the book value adjustments. Then we've got some ones that are cash, like asset replacement, building reserve, emergency response, and Kiriwai, which is actually restricted, because by restricted it means it's got specific use that it can be applied to only. It can't just be used for any expenditure the council may choose to. And then public equity is basically the targeted reserves, and the balance then becomes the general reserve. And the targeted reserves, there's reserves for each river or river management scheme, there's flood and drainage schemes, there's transport, and the other targeted reserves we've got around catchment management, biosecurity, etc. They should largely be zero, but there will be some small amounts that, unders and overs that flow into those. Last thing that the financial strategy mentions is insurance, and this will probably come through more in stuff that Tammy will do, but financial strategy has to outline what we do around insurance, and operational assets are fully insured, like our buildings, vehicles, all of that sort of stuff. Infrastructure assets aren't. So flood banks, drains, culverts, effectively we're self-insuring. The rationale there is that, there's a very low probability of complete loss to all the schemes at the same time, or to even all of a single scheme. And a lot of the assets like flood banks are basically, have the same characteristics as land. So we have looked at this, tried to get quotes for if we wanted to insure. Some regional councils do have insurance for their flood banks. It's historic. Once they've had it, they've been able to retain it. Every time we've gone to market, we've just been given a blanket. Nobody's interested in offering new insurance. And effectively, the scheme reserves insure other self-insurer.
Yeah, we're doing a workshop on insurance specifically. It has been a problem for us in the last couple of years. Those who sat on audit risk, we had quite a few discussions on insurance, just the insurance market generally for local government with all of the climate related natural hazard events, particularly those big ones in the North Island and Auckland, have impacted the ability for local government to insure. And we found that at the time of our last renewal. We've just changed brokers and they did a good job in this first year. And so they will run a full workshop for councillors that are interested before we head into negotiations for next year's insurance. So that'll be another one that comes through as well.
So on to revenue and financing policy. So as I said, I've mentioned, so I'll try and blast through these because we're running out of time, but you know, people can come back if they want to go through any of these asking questions, but did a review in the last LTP, took a wider first principles approach as we actually looked at everything. So we looked at all and multiple rates were reviewed and changed. We tried to have it strategy led rather than legislation led. I mean, legislation was important, but we didn't want it to constrain the thinking and, you know, make the review too narrow. As we sort of went through earlier, legislation tends to focus, or it had led to us focusing on that benefit exacerbator focus, whereas the review wanted to bring in what about the wider community outcomes and well-beings. The focus of the review was on flood and drainage schemes and transport, because they were the areas with large deficits and or where there was large forecast expenditure. Went through went through looking at the principles that we were going to undertake the review on. A lot of where we landed on them, that I think they were really good, the principles, but there's always going to be conflict between the principles. And there's also going to be subjectivity and judgment involved in applying the principles. So, it wasn't a simple formula that we came out with. You've still got to, you've still got to work your way through and land where you land. And yeah, some people will still disagree or not like it. So it was important that that judgment was applied consistently. Key thing that to note about the RFP is that revenue and financing policy determines the allocation of rates. It doesn't reduce the overall level of rates. So, and once you start reallocating rates, if there's no reduction, if the total's the same, you're naturally going to have winners and losers. So, while some people might be happy, others won't be. Principles that we landed on, they're in the revenue and financing policy. So, in three categories, we wanted our revenue and financing policy to be workable, to be fair, and to be sustainable. Use of the principles, as I said, use them to guide us through doing the funding needs analysis. And some things that we were looking to do, we were looking to get simplify and get consistent general rate allocations. That doesn't necessarily mean the same percentage, but certainly applying the same logic that if there is going to be general rate allocations, it should apply consistently. That that you do go, oh yeah, we have general allocations in this particular type of rating, but not in that. We wanted to move to less benefit zones and simplify that. It is that when you get into the flood and drainage and the benefit zones, very complicated, very technical. So wanted to simplify that, and we did do, but there's still some more further work going on in that. And we wanted to, just remove or merge rates where small amounts and remove the use of differentials if they weren't really adding any benefit. Funding needs analysis, that just shows as you get into benefits exacerbators will sort of lead you up into that targeted rates, general rates when you're looking more at wider outcomes and well-beings, you'll be looking to use more general rates. That's just a simple sort of graphic to where you'd sit. These next ones, now this is the stuff that I did send out those other attachments. This is just an example of the funding needs analysis, which I sent you the final version of that. This is what we went through for each activity, was going through the community outcome, distribution of benefits, period of benefits, and I can't, and the exacerbators, and then had the column on the right was after all of that, did it warrant separate funding? So we went through this for every activity. This is just the governance and democracy one. We then, we then came up with the bit down the bottom, which is what the funding policy would be for each of those activities under, or each of the parts under that activity. So we did that. If you want to go look at that document, I can't remember how many pages it is. It's quite a lot, but you can go through that. It's there for each one, and we worked through that. That then led to the revenue and financing policy itself, which has this summary in the back of it. And if you look there, what you're seeing is by each activity, and these are color coded because these are we've got 4 groups of activities. I didn't put the last one on there, but in the regional leadership, governance and democracy, you go through, it's got those sub activities, and you can see there the bulk of that is 100% funded from general rates. So it's really this just gives a good visual table on, if you take an activity, where does the funding come from? And it can be, some of them will have a mix of grants, general rates, targeted rates. And the other thing is just moving into so those 2 documents, the revenue and financing policy and funding needs analysis I attached. The other one I attached was one that is a funding policy summary. So again, this is what you just saw in the revenue and financing policy. It's a little bit different format, not required under the legislation, but it just gives a summary going out. And if you wanted to look at this highlights in those colours, like the blue and the green, and then the red notes, highlights all the changes that we made in the last RFP review. So where we went to, like you can see there, freshwater farm plans, we were looking to bring in a new farm plan rate. It says it was going to be new because it was a new activity from year 2. Now, it never happened in year 2 because the legislation changed and it dropped out. But if you go down the bottom of this page, harbour management, we brought in a new navigational safety rate. And it was by district, and it was uniform across the districts, yeah? And you can see there in red, we just note it was a new rate. Previously, that activity had been funded by a sub-regional general rate. So, if you got that document, it's about 4 or 5 pages, gives you a summary of where all our activities are rated, the mix between targeted general fees and charges, but it also highlights all the changes that we made 2 years ago for the LTP now. Yep. I've actually put them all in here. I've got each of the individual pages. I won't run you through them now because I only got 5 minutes. So you can read these if you go through and if you really want to dive into more detail, just give me a yell and I can sit down and talk you through this individually. Yep. But it's all put in here so that, yeah, you got 4 pages. Gives you the rundown. General rates. So just things to note on general rates. General rate applies to all rateable land in the region. It's charged on capital value. Rationale for that is that the general view is that capital value is better aligned to ability to pay. Don't confuse ability to pay with willingness to pay. There's plenty of people who got the ability to pay, but absolutely no willingness. Uniform annual general charge. So on general rates, we charge 25% of general rates is charged on a uniform basis. So that just means that of those 127,000 properties, they all get a UAGC, which is about it might be about $70 now, 73, 68. Okay, yeah. So it ensures that a minimum amount is charged to all rating units. So even if incredibly, somebody's just land banking, they're still going to get a minimum. And it assists in managing the distribution across the districts. And we've already talked about valuations because the valuations differ, the cycle differs across the districts. And so we equalise the capital values to take account of that. But the other thing is we do have 25% of the general rate is on a uniform basis. No other differentials in general rates.
That's capped by law at 30%, isn't it?
Yeah, I think I've got that in,
That's
in
right, yeah.
another one, but yeah, your uniform rates, and I'll go, yeah, I've got it there. So then just the last section I've got, I'll blast through these really quick. There is a few.
We can go a little bit past it.
Oh, okay, but a few of these are old slides that I haven't updated, but they're always interesting, and it just might be interesting for you just to get the background. But just some more info on rates. Rates are a tax, so effectively it's a land or wealth tax in disguise. You know, it's important not to confuse them with the direct payment for services, because that's what fees and charges should be doing. User pays as fees and charges. Like I said, bus fares is user pays. Just so happens that there's a whole lot of other amount that subsidises that, like the subsidies and other then rates. So yeah, you want to bear that in mind. Ultimately, with rates, it's elected members, it's up to you to decide on the appropriate allocation. There's no set formula. Rating reviews always gets talked about. So they're about the allocation of rates. They're not about the total amount being collected. So if the issue is the total amount, that's actually a budget or a level of service issue, not a rates issue. Rates is just the result. Fundamental rates considerations, you've got things like, do you use targeted versus general? Do you use uniform, you know, UAGC? Do you do that on a percentage of general rates, or do you do it for specific activities? You got your valuation basis to consider. Do you use capital value, land value, or land area? We use all three. Use capital value a lot, but we've still got land value and land area for certain rates, and differentials. You know, you can do it on land use, you can do it on area. So there's a lot to consider in there. Rate types. General rates can use differentials like location. We've moved away from that, and can be differentiated on land use as well. Again, we don't use any differentials. Can set a uniform annual general charge, although it says annual general, the UAGC, which is on the general rates, there's a cap, and this is what Neil was alluding to, of uniform rates, whether it's the UAGC or any other uniform rates. Collectively, uniform rates can only be 30% of your total rates. Yep. But for a rate to be uniform, it has to be charged on every single property. So if you say have a targeted rate that only applies to one district, but it's uniform within that district, that is not a uniform rate for the whole of the region, so it doesn't count in the 30%. It actually has to be uniform across all of the 127,000 properties. General rates can be based on capital value, land value, or annual value. Annual value is, I don't think any council uses it. Apparently Auckland used to use it back in the day. It's got some calculation around what some sort of calculated rent value would be. And I think, but way too complicated. It dropped out of favour a long time ago. Targeted rates are more flexible than general rates, and you can use land area as a basis for targeted rates. Just got a couple of slides here just on those. So if you look at those things, all I've put here is the advantages and disadvantages of like using capital value or land value as your basis. So you can probably go through these things. Like I said, you know, capital value is understood. There's the general view of that, you know, it's linked better to ability to pay, but got the disadvantages of, you know, it will penalise asset rich, cash poor property owners, things like that. So I won't go through these because you can just read through these. So if you're considering capital value versus land value, that's just some points to note.
You have both though.
Yeah, for different rates you can use, but you can't use, could you use both for a same rate? You probably could, but you'd be complicating it. There, you know, Generally, people don't. It's usually just a rate is usually just done on one or the other. Again, same thing, advantages, disadvantages of UAGCs, and advantages, disadvantages of targeted rates. So you can read through those. If you've got any questions, come back. And then I did just put these last few, just a couple of, I done these a long time ago, and they're actually a bit old because I've come out of the the Productivity Commission, got this report done, and it just showed, this one is showing all the councils in New Zealand, the split of what they do of the use of targeted versus general versus UAGC. So the big blue bar, the dark blue bar on the left is targeted rates. And you can see up the top, there's some councils that 100% use targeted rates, no general rates, no UAGC. And then you get other councils that come down in the green, they're using general rates, and the light blue is UAGC. And you can see there just highlighted, we're sort of mid in the pack, where we've got general rates, we've got targeted rates, and then we've got general with UAGC. Now this is from 2019, so it's old, but it's just, I always find it interesting, and if you want a bit of context for what happens in the local government. And what's interesting there is at that point, 3 councils didn't use general rates. Highest general rate use were Auckland and Kawerau, which were effectively the largest and the smallest council in New Zealand. So it's sort of highlighted, there's no set formula or rule of thumb. Councils do all different things, and they all set their own, way they want to rate, and which is what you're allowed to do. This one was also out of the same report, was the rates percentage of income. So again, all the councils in New Zealand, percentage of income, you could see right down, we're down the bottom, 4th from the bottom, and we would have been there, we were a bit over 40% at that time. As I said, this was going back, 5-6 years ago now. We're still, at about 50%. I don't think we're quite at 50 yet, or we might be about 50. But yeah, you can see there that we didn't at that point, and we still don't have as big a reliance on rates as other councils. But if you note, all of the regional councils sit down the bottom of that list. Yeah, we're all in a very similar space, probably because we get a big chunk of our activity is public transport related, which is as NZTA. Most of us have either ports or investment portfolios that fund a big chunk of what would otherwise be rating activity as well. But a lot of those bottom 4 are all regional councils, and then I think there's another couple just 2 up. So like I said, old information, but I find it fascinating. But that's me. And then this last one is just one that we always like to put out. It came up when we were doing LTP, and again, it links back to distributional rates. I haven't updated it because I didn't have time for where it sits currently. But back in this was the 2023 rates. We had a look at where do the rates invoices actually go, and what's fascinating is
not the resident.
What?
The land here, where the bill is paid.
Exactly. Yeah, so it's where, because it's where the rates invoices actually go based on the postal address. And you can see there, for most of them, it said that, so that top percentage up there, Sequel Otago is a bit lower at 66, but then you've got Clutha, Dunedin and Waitaki. They got 72, 88 and 78% of those rates invoices are going to their own district. Yeah. And then we sort of showed the other districts within Otago. But Queenstown Lakes, way lower. Only 55% of the rates invoices go to an address within the Queenstown Lakes district, which is quite low. And you can see there, you then look at the percentage going to Auckland, overseas Canterbury. You get, so it just highlights, it's what you'd expect. There's a lot of investment property there. Or you've got the things of, you've got hotels and, you know, national and international businesses based out of there. So we always just find that one fascinating. I know it's one of your favourites, isn't it, Richard? Yeah. So I thought I'd throw that one in, but at some point we'll update it because I'm always keen to see whether it's changed or not.
Nick would love it if you hit him up for a chat about some of the stuff. Absolutely lives for it.
Has anybody actually done that?
Yeah.
Even talk.
Oh, no, so, yeah.
No, nobody ever.
Oh, no.
Nobody ever comes.
Excuse me, I have, just not with the council. But lots of conversation.
So look, that's, thanks, Nick, that's, a lot of information, which, and there's a lot to take in there, but I think, the purpose of that was, again, as with all induction, very broad brush, and probably more so to give you an idea about areas that you may want to look into a bit further and potentially, you know, just get some more guidance from Nick around where to look for certain things or ask questions just to help understanding before we enter annual planning process and then ultimately long-term planning process where we do look at things like financial strategy and some of those things. So yeah, look, it's good to have that material, there's those attachments as well. And then, you know, as much as we joke about that, that is what Nick is there to do, is to provide that support and advice in some of those areas that people might want to dig into a little further, just to help your understanding of how our finances are structured and obviously rating system as well. So with that in mind, that's the end of the workshop today. We pick up on some of these topics through further briefings. I think Tom's doing briefing tomorrow, which includes a bit more information about some of the rating of the schemes and some of the work that's being looked at there based on a previous council resolution to review some of those things. So this will keep coming up again through different briefings. And obviously we've got a full day planned, we've got a paper and then a full day planned on the annual plan as well, which is where we really are looking to get some guidance, not decisions, but certainly some guidance from council as to how we structure the annual plan for year 3.
That's after the 26th, isn't it?
Correct. Yeah, it's early December. Yeah. So that's us. For those that are joining us for the tour across the road, we're going to meet over there at 4 or a couple of minutes before then. We're meeting at the Wagon Street entrance. So we used to drive in under where the warehouse car park is. Oh, hang on, no, Tammy might have changed.
Yeah, so it's still on McFagan Street, but past the building and the Sawtooth stables, we're all just gonna meet there. If you do have your boots, please bring them. There will be PPE available for those.